Okay, so good morning everyone and welcome to another session of our investment banking course. I see from my dashboard that about 30 people are already connected, and for those of you who are on time, it's time, I believe, to start. First of all, I kindly remind you to register your attendance using the application because this is required for synchronous online sessions from Bocconi procedures. So I really appreciate if you could do so. Before starting this session, I have a couple of communications for you. The first one is something related to the preparation of the mock-up exam text. I am in contact with Professor Della Ragione and Professor Gigante, the team members of the faculty, and we are preparing the text of the mock exam. Very likely it will be ready by end tomorrow, but I will be more precise as soon as I have additional information. So don't be scared. Everything will be ready in due time so that you can have a look at what the style and the tone of the exam will be. The second communication is instead related to what we are going to do today. Today, basically, we are going to analyze a couple of points related to how private equity investments are carried out. Last time, we had the possibility to understand that there are basically two structures with which we can convey money to private equity investments. The first one is the limited partnership model, typical of Anglo-Saxon countries, and the second one is instead the closed-end fund, typical of continental Europe. It's now time to understand how the general partners in the limited partnership structure and the management company in the closed-end fund get money out of their task of managing these funds. This has to do with the fee structure of private equity vehicles. We will try to understand how much it costs to limited partners to participate to these vehicles. And clearly, you can imagine that the higher is the cost of these fees, the lower will be the released return that these investments will be able to generate across the whole life of the vehicle, which is indeed the second point we are going to discuss, how to capture the measure of performance of these investment vehicles. So all in all, be prepared today to work a little bit with numbers because we are exactly focusing on how much is the cost of the vehicles and how much this cost transfers in terms of depressing the performance of these vehicles. Since this is an online session, and I know that you class are very active, I kindly encourage you to submit me at any time any question, any doubt, any request of clarification. Always more than glad to help you and assist. Okay? So, coming to the agenda for today, the agenda for today is very simple in a sense that we will have to go through only a couple of points, but they are pretty dense from the point of view of the contents. The first point is essentially having a look at the fees that investors in private equity vehicles pay to the general partners or management company. And we will see that this classic structure of fees is represented by the so-called 220, where 220 indicates the two components of the management of the fee structure. The first one will be defined as the management fee, and the second one is what we already know because we have already named it, the so-called carried interest. We will try to understand what these two components are and how they can be calculated under different assumptions. Once we have analyzed the fees, we will be ready to move to point number 2. So, assessing the performance of private equity vehicles, assessing the performance. And we will see essentially a number of points in terms of the different alternative measures and second point, we will have the possibility to apply the different measures to an application that will summarize most of the things that we are going to discuss. Okay? So only a couple of points, but be ready to work intensively with me on essentially numbers. So today we will have a little bit to do a bit of number crunching, but this is the price to pay in order to, understand exactly how these vehicles work. So going back to our previous session, we left the analysis to the analysis of the two structures, the limited partnership one and the closed-end fund one. And we have seen that in both cases, the two vehicles go through the same life cycle with a fundraising period, an investment period where investments are made, and then a management period dedicated to managing companies and divestitures. We have seen more or less that in a number of cases, the investment period lasts for 5 years. And indeed, if you look at a sample of private equity funds operating in a number of different segments, buyout, growth, venture capital, etc. And if you look at the median or the average duration of the investment period, you will see that in most cases, the most recurring number is exactly 5 years. So during this vehicle life, investors participate and they delegate most of the decisions that are crucial for the success. So the identification of the companies, the assessment of the companies, the monitoring, and the exit via divestitures to the general partner or management company. Clearly, the management company doesn't do so for free. And so we must exactly understand what the investors pay for this service. And we are entering exactly in point number one of our agenda today, the fees. In terms of fees, we have typically a structure that is pretty standard in the world of private equity that pays the service of the general partners in two different forms. One paying a management fee, and the other one the carried interest. Let's understand exactly the type of fees and the objective of these fees. First of all, the first component is represented by the management fee. The management fee is typically paid annually as a percentage of the committed capital. And typical, this percentage is the 2 of these 220. So typically, the management fee corresponds to 2% times the committed capital. Remember that the committed capital is the amount that is fundraised by the fund every year. And as you can imagine, this 2% is an amount that must be paid in order to allow the general partner to pay for its own operational expenditures, the day-by-day business. And so it's a very stable base of fees for any institution that operates this business. Much more stable, as you will see with Professor Della Ragione, than M&A fees. Because you can imagine that if you are an M&A advisor and you don't have mandates, you don't gain anything. If instead you are a general partner of a private equity vehicle, you are able to collect every year 2% times the committed capital, whatever it takes. So it's a very stable base of revenues, of sources of cash. Clearly, you can imagine, guys, that this kind of management is due regardless the performance of the vehicle. So if the vehicle is doing well, I pay in any case 2%. If it's not doing so well, anyway 2%. If it's playing bad, I pay again 2%. So it is something that is very good for the general partners, but absolutely not incentivizing to do the best for the investors. And so, in order to incentivize the general partner or the management company to do the best as a fiduciary duty for the limited partners or the investors, we must add an incentive. And this incentive is represented by the so-called carried interest. And this carried interest is, if you want, something that you can imagine as a sort of add-on to the fees that is paid only if the general partner is able to generate more value than the amount of committed capital originally committed by the limited partners. If you want to simplify a lot, if you have committed capital for 100 million euros and at the end of the life of the vehicle, you have been able to generate more than 100 million euros, the delta, the capital gain, will be not paid exclusively to the limited partners. Instead, it will be split in between the general partner and the limited partners. And the component paid to the general partner of this capital gain is called, with the technical term, of carried interest. So essentially, this is, if you want to keep it as a simple kind of intuition, is an X% of the extra value generated in the vehicle, the extra value on top of the committed capital. And this is exactly the second number here is the 20. So typically 20% times the extra value that is paid to the limited partners due to an increased value of the fund or of the limited partnership is paid to the general partner via the payment of carried interest. So if you want, this is a strong incentive to do the best in order to maximize the value of the investments. Clearly, there is a drawback. It is an incentive, definitely, but however, it typically forces the general partner sometimes to take excessive risk, so to boost this extra value and to boost potentially the carried interest generated. Okay, so in general, the 220 rule is exactly based on these two numbers, where 2 is the annual management fee and 20 is the percentage of capital gain recognized to the general partner, typically once you know, which basically takes place at the end of the life of the vehicle. In reality, guys, things are a little bit more complicated, but important for you is to try to remind the philosophy, the rationale. One is paying the day-by-day costs, and the other one is instead paying the brain and the skills of the general partner. Without saying that sometimes these 220 can change. More precisely, In general, when the market is particularly hot, there is a lot of liquidity in the market. Investors are eager to deploy money, as it happens today, in alternative assets. The more likely this 220 is lifted up. So the bargaining power moves from the investors to the general partners. Recently, for example, some vintages of investment in private equity have been priced at 330. So 3% management fees, 30% carried interest. Because in reality, there is so much liquidity in the market that at the end of the day, general partners have a good play in the negotiating power with investors. Without saying that sometimes these fees instead can be discounted. There are a number of cases where you can discount as a general partner's fees, but there are two of them. The first one is the so-called early bird discount. So when you launch a fundraising campaign, you promise to investors that subscribe first a little bit of discount, typically on management fees. The second discount is big ticket deals. So if you commit a large amount of capital, like it happened, for example, for Blackstone, when he asked the private investment fund in Saudi Arabia to subscribe a big portion of Blackstone infrastructure fund, they offered a very generous discount because this investor was a big fish. And so at the end of the day was rewarded with the reduction of these fees. Okay, so it is not carved in stone. In general, if we look at basically the market confirms that in reality, management fees and carried interest are typically placed in the 220. For example, if you look at this chart here that tells you what happened for the vintage year 2016, 2017, you see that 20% carried interest is required by 82% of the funds in market. So it's a pretty standard kind of measure. Okay. Any question so far? Sufficiently clear? I'm going pretty quick because it is, I would say, pretty standard. Cesare, good morning. Professor, could you please state again the name of the second type of discount? Big ticket. Cesare, it is a big ticket, meaning that if you are a big investor, essentially you can get a discount exactly because you take a big slice of all the amount that must be subscribed. Okay, very good. So if it is clear what a management fee is and what a carried interest is, let's do a very simple kind of number crunching, just to, break a little bit the ice today. Suppose to consider a fund whose committed capital is 100 million euros. So you have fundraised 100 million euros. Suppose that the life of this fund is a standard 10 years. Suppose then that the management fee that you have agreed with this fund and with the investors in this fund is represented by 2%. Look at these three numbers, because these three numbers tells you an interesting point. First of all, you can imagine that every year you will pay a management fee of 2% times 100 million. So you have 2 million euros per year. But considering that you have a fund life of 10 years, during the whole life of the vehicle, what is called as lifetime fees, you are going to pay to the general partners 10 years times 2 million per year, or 20 million. Which basically, guys, implies that given a committed capital of 100 million euros, So you promise the general partner to bring to the fund or the limited partnership 100 million euro. But you know since the very beginning that 20 million will be pocketed by the general partners. And so this 20 million will not be invested in companies. The difference between the committed capital and lifetime fees is defined as invested capital. So it is the amount of money that is really available. It is left invested capital. It is the amount that is invested in corporations, and it is 80 million euros. So you can imagine, guys, that in reality, the amount of capital that is put at work to generate value for the investors is not 100 million, but it is only 20 million. And as you can imagine, the incidence of this 20 million over 80 million is a remarkable 20 million over 80 million is a remarkable 25%. So this fund is able to break even in a simple interest calculation with no capitalization only if it's able to generate at least 25% over the invested capital. So this means that the general partner must be very skilled in order to identify investments that are really able to, in a sense, generate sufficient money for the investors to fully recover the amount of fees that have been paid. Okay? This is just to remind you the concept of lifetime fees. Lifetime fees are a sunk cost for the investors. Now, in order to understand instead how the carried interest typically works, we have to take into consideration another point. The idea with the carried interest is always the same. Remember that carried interest is based on the capital gain. So, considering again our example, if we assume that the committed capital of this private equity fund is 100 million euros, which is indeed broken into two components: the invested capital, 80 million, and the lifetime fees of 20 million, you will be able to pay a carried interest only when the final value of all the portfolio of the fund will exceed the original committed capital. So you will pay, as you can imagine, a carried interest to the general partners only if you have been able first to completely repay the invested capital, second, to completely repay the fees, and then to generate this extra value here. And this extra value here will be split according to an X% in terms of carried interest to the general partner and 1 minus X% to the investors in the marketplace. Okay? So the concept is that we must exactly now understand how this carried interest is calculated. Intuitively, it's very easy, but in reality, there are a number of different variants that can be applied in real life practice. More precisely, there are basically three alternatives that we are going to explain and that I have reported in the final part of this chart here. three variants, three different possibilities. The first one is the calculation of the so-called simple carried interest. The second one is the carried interest with, again, another term that we came across in the previous section with the so-called hurdle rate. And the third one, typically the catch-up clause associated typically with the hurdle rate. So we have three possibilities: the simple calculation, the second one, the existence of an hurdle rate, the third one, the hurdle rate plus the condition called as the catch-up clause. Okay? In order to understand exactly how the different types of carried interest are calculated, we can maybe refer to a simple example that I have prepared for you in this set of slides. Suppose, for example, that we are considering a fund with the following characteristics. So first of all, we have a committed capital of 100 million euros, and we assume, this is our assumption, that this committed capital is committed fully in the first year of the life of this fund. So 100% available for investment in T0. At due time, we will assume that this fund has an hurdle rate. The carried interest for this fund is set at 20%, and at due time, we will assume that there is also a catch-up clause in action. We assume, in addition, that there are two assumptions. The first one is we are in an ideal world where no management fee is due. This is a strong assumption, but I prefer to show you the pure functioning of the carried interest without the interference of a management fee. We will then remove this assumption. The second assumption we make is that the fund has a life of 4 years. So it's a very short fund: 0, 1, 2, and 3. So our assumption is that we are able to invest all the capital at time 0. There are no management fees, so the invested capital is equivalent to the committed capital because you don't have any fee that is due annually to the general partner. And we assume that there are 3 years of life where we have the possibility to liquidate the investments we made in T0 in 3 years for the following amounts: 109 million euros at the end of year 1, 1 million euro at the end of year 2, and 10 million euro at the end of year 3. What is our task is to try to understand how to calculate the carried interest under the three different assumptions: the simple carried interest, the carried interest plus hurdle rate, and the third, plus hurdle and catch-up. Okay, this is what we are going to do. In order to do so, I have prepared a simplified Excel file that I'm going to discuss with you in order to show you what really happens. Please, we are entering into calculations, so if something is not clear, please immediately stop me and ask questions. Let's start from this first example. So, what we know is that the committed capital, according to our example, is 100 million. As you can see, my assumption is that there are no management fees, and instead, the 20% carried interest is in place. In this part of our exhibit, we are going to show the trend of the life of this fund. As you know, we are on a time horizon of 4 years, years 0, 1, 2, and 3. We know that the invested capital, which is equivalent to the committed capital because there are no management fees, is fully contributed at year 0. And then we know that there are 3 divestitures, 109 million year 1, 1 million year 2, and 10 million year 3. So that you can imagine that the cumulative value, liquidation value, at the end of the period will be 120. You can immediately notice that since the final liquidation value is 120, but the committed capital was 100, you have essentially a gain of 20 million, and intuitively, if you have a carried interest of 20%, 20% of this 20, or 4 million, will be paid as an incentive to the general partner or the management company. I think it is pretty intuitive, okay? But how exactly it takes? So we expect that on more or less the value that we are considering in terms of carried interest is around 4 million. We will see that this 4 million changes depending on how it is distributed throughout year number 1, 2, and 3, and according to the type of clause that assists the payment of the same carried interest. Let's start then from the purest form, the simple carried interest. With the simple carried interest, the idea is that, well, returning to our Excel file, we must look at how every year of liquidation we split the divestitures. So in year number 1, what happens? In year number 1, you liquidate an amount of 109. You know that before paying any incentive to the general partner, you must repay all the committed capital. So until the committed capital has not been fully repaid, no incentive can be paid to the general partner. And I think you can agree with me, this is a fair assumption. So with this 109, first I reimburse all the committed capital to the limited partners. And then what is left is 9 million. And since we have decided that 20% will be paid in terms of incentive and 80% will be recognized to the investors, you can see that 20% times 9, or 1.8, will be paid as carried interest to the general partner, and 7.2 will be paid to the investors. And the sum of these 3 numbers returns exactly the value of the divestiture of 109. Okay? The same holds true in year number 1. From this moment on, guys, you can imagine that the committed capital has already been paid, and so at the end of the day, this can be easily split according to the 20% rule, so 20% to the general partner and 80% to the investors. And the same holds true in year number 3. So you have 10 million, you are comfortably in the area of capital gains. So again, the distribution follows the usual rule, 80% to investors and 20% to the general partner. All in all, if you sum the rows of committed capital plus money paid to the limited partners, you can easily see that at the end of the day, I generate 100 plus 72 and 08 is 8 plus 8 is 116, the number that you see here, the amount received by the investors. And if you sum 18, 02 is 2, and 2 is 4, this is the amount paid to the general partner, exactly the number that we had calculated intuitively, considering the cumulative value at the end of the liquidation. Is it sufficiently clear how a simple carried interest works? I think it is very intuitive. Okay? Any questions so far? Crystal clear? If we want to complicate a little bit more the story, we can refer to the second alternative, which is, among all the others, the most favorable for the investors. So, when the market is a little bit depressed, when you want to tease the investors toward this kind of investments, the possibility to propose an harder rate is sometimes the trigger to attract more capital. What is an harder rate, and typically how an harder rate works? With the harder rate, we can imagine that the type of incentive is very much likely to be the same than the case of a simple carried interest. So again, you have the committed capital here, like in the previous case, and you have a given liquidation value, this amount here. When an harder rate is in place, and suppose that this harder rate is an Y% times the committed capital, the story goes that before paying any incentive to the general partner, you must, first of all, repay all the committed capital, but, and this is the difference, a portion, an additional portion, that is represented by Y% times committed capital, must be recognized to the investors before any incentive is paid. So, assuming the same liquidation value, then this part, you can imagine that this slice here with striped red lines reduces the carried interest paid. Just to do it with numbers, if you have a committed capital of 100 million and you have another rate of, say, 5%, you must repay first 100 million before paying any incentive, plus 5% on that committed capital. So the threshold above which you can pay an incentive to the general partner is no longer 100, but it becomes 105, plus the other rate. This is from an intuitive point of view, okay? So, if this is how the other rate works, we can return to our example, and we can show how numbers change. And the numbers change clearly in favor of the investor. Why? Because, again, we have the same numbers, committed capital 100 million. Again, we assume that in these simulations, we don't have any management fee. We have the standard carried interest of 20, but a new condition appears, the harder rate of 8%, which basically means that if we do it with simplified cumulative numbers, the harder rate, which is not, this is important, guaranteed. So no one's guarantee you guys that you will receive 8%. And likewise, no one guarantees you that you will be able to get back your invested capital. If your general partner is a disaster and makes very bad investments, the risk of your investment is on you, not on the general partner. However, If the general partner is a successful one, you are guaranteed that on top of the reimbursement of the committed capital, you will be receiving an hurdle rate of 8 million euros, which is 100 million times 8%, which basically means that the carried interest, put simply, will be no longer 120 minus 100, but 120 minus 100 committed minus 8 million hurdle rate times 20%, which is definitely lower than 4 million. That is the number that we have calculated in the previous example. But let's see with the numbers how it works. The usual distribution of funds, 100 million paid today, 109 liquidated in year 1, 1 in year 2, and 3 in year 3, and 10 in year 3, with a total cumulative liquidation value of 120. What happens? It's very similar to what happened before. In the first year, you liquidate 109. Before paying any incentive, you must, first of all, fully repay the committed capital, 100. But now you have also to recognize an extra value of another rate. Please notice that with the liquidation value in the first year of 109, we are able to pay in one shot all the committed capital and all the carried interest. Remember that until these two values are not repaid, you are not authorized to pay anything to the general partner. So the story is investors first, general partners later. And since something is left, which is an amount of 1, which is a full capital gain on top of the other rate, then the usual rule, 80% to investors, 20% to the manager, is applied, so that in the first year, 0.2 million goes to the manager and 0.8 go to the investors. Pretty easy. In year number 1, a divestiture of 1 million. You have already satisfied the invested capital and the other rate, so the usual rule, 80%, 20% applies. So 80% to investors, 20%, 0.2 to the general partner. And the same holds true for year number 3. You have total liquidation value of 10. You have already repaid committed capital and other, and so the usual 80%, 20% is applied. Please notice that if you consider, in this case, the total values, investors have received 100 million euro back invested capital, 8 million hurdle rate, and then 80% of the extra value. So an amount of 108 plus 9.6, an amount of 117.6. That, compared to case number 1, is higher, exactly because the amount paid to the general partner is lower. And the amount paid to the general partner is now almost halved compared to scenario number 1. In scenario number 1, he received a carried interest of 4 million. Now he receives only a carried interest of 2.4. And so you can imagine why the hurdle rate is used in order to attract investors when the market is a little bit cold or not particularly open to carry out such kind of investments compared to other more traditional asset classes. Okay? Is there any question regarding how the hurdle rate works? Matteo, good morning, Matteo. Professor, what is the most common on the market, please, with or without catch-up? First of all, thanks, Matteo, for the indication. First of all, let me just show you one piece of evidence that could be useful. In general, when you talk about hurdle rate, Matteo, and if you look, for example, at one vintage year, the 2016-2017, among others, you can see that the hurdle rate of 8% is proposed by almost half of all the funds in the marketplace. So this chart is telling you that there are a number of different potential hurdle rates, but that 8% is the commonplace, the common practice. 52% of the funds in the market propose you an hurdle of about 8%. To answer your question, which is the most common form? In general, the most used structure of carried interest is carried interest plus hurdle. That today, exactly because the market is hot and there are a lot of investors that are willing to invest, I have seen funds that have reduced it to 6%, also sometimes to 5%. So we are now in the current market conditions on the left-hand side, and Matteo plus a catch-up. This is used in almost 80%, 85% of all the funds in the market. And this is pretty standard as a market practice. Okay, Matteo? Clarify your point? Very good. Any other question? Lucas, good morning. Professor, is the carried interest paid after any exit or at the end of the fund lifetime? Nice question. Both versions. I mean, Lucas, when there is no standard in the world of private equity, because these are alternative asset classes. So whenever, as an investor, you are approached by a general partner, you must read carefully the prospectus, because devil is in the details. In reality, the carried interest can be paid on two different standpoints. The first one is the so-called fund base. Lucas, for you is based on the cumulative final value. So you pay a carried interest exactly as I showed you with my examples. There are some other funds that instead pay carried interest on so-called deal base. So, Lucas, in this case, if you liquidate a portion of the fund, even if the fund hasn't already collected all the committed capital, I can also distribute carried interest. And this can have some, let me say, unpleasant side effects for the investors. So, Lucas, it really depends. I don't have a definitive answer because it is really market practice. There is no standard practice. There are some funds that pay the carried interest on the cumulative basis, so-called fund base, or there are some others that pay the carried interest on a deal base. So, deal by deal, I calculate the carried interest. So, if I made an investment in company X and I divest company X at a higher price, I can apply carried interest. If I have invested in company Y and the liquidation value for company Y is below the acquisition price, this doesn't trigger the payment of carried interest. And this is on a deal basis. Clarified, Lucas? Very good. Any other question, guys, regarding hurdle rate for the time being before moving to the catch-up clause? Okay. With the catch-up clause, the story is, Cesare, isn't time value of money accounted for? In principle, Cesare, I would say the answer is obviously so, but for the time being, I do not consider it, because my focus with these examples is to show you how to calculate annual cash flows. We will then, Cesare, we'll use the same funds, the same cash flows to, let me say, apply the time value of money. But this is something that has to do with the performance valuation. So you will be satisfied by the end of this session. So Cesare, I buy your proposal, absolutely correct, but don't miss the point. In this phase of our meeting today, I'm clarifying you how to calculate these compensations, not to treat them with the time value of money. This is the second step. Okay, very good. Nice. Now, the third version is the Ardo rate plus a catch-up. With a catch-up, the story becomes a little bit more complicated, and that's why before showing you the Excel file, I prefer to use the whiteboard. So we have time 0, time 1, time 2, time 3, and then the sum. We know that the cash flows are represented by the committed capital that is contributed at the beginning, so minus 100. And then we have divestitures for 109 million, 1 million, and 10 million for a total value of 120. In this case, we assume that an Ardo rate of 8% is in place, like in previous example, but there is also a catch-up. The secret to understand how the catch-up works is the following. In the previous examples, we said every extra cash flow on top of the committed capital and eventual Ardo rate goes to the investors first, and what is left is paid to the general partner. With a catch-up clause, the story is the opposite. Once you have overcome the level of committed capital, every extra cash is paid first to the general partner, and what is left is paid to the investor. This is the concept of catching up, capturing, attracting the extra value to the general partner rather than to the limited partners. What is the meaning of catch-up can be obtained very easily in this way. Look carefully. In year number 1, what happens? We have the limited partners here and the general partner. Let's start with the first year. Year 109. Year 1, 109. In year 1, we know that the limited partner is entitled, first of all, to receive back the committed capital, 100, plus the Ardo rate of 8%. Okay, so he will definitely receive 108. But 1 million more is available. The general partner goes to the limited partners and say, listen, in this year, the gain that has been obtained, regardless the Ardo rate that I have paid you, because I have paid you, is 9. And so, exactly because we have entered in the area of capital gain, guess what? I am entitled to receive, according to the rules, 20% of this gain, which is 1.8 million. However, the amount left after the payment of 108 million is only 1 million. And given the catch-up and general partner gets first and the investors get later, this 1 million is paid all to the general partner and the investors get 0. So the distribution in this year is 108 million to the limited partners and 1 million based on the capturing effect of the catch-up goes exclusively to the general partner. Easy, intuitive. What is left on top based on the percentage of carried interest is captured first by the general partner, and what is eventually left is given to the limited partners. Catch up. Let's see what happens in year number 2. In year number 2, another divestiture is made that brings the cumulative gain to 9 million plus 1 million, which is 10 million. The general partner goes to the limited partners and say, hey, I have the right to receive 20% of 2 million, okay, of which 1 million already paid in the previous year, minus 1 million paid in T1, leaves me with an amount I am entitled to receive of 1 million. How much is the cash available in year number 2 to make the payments to the limited partners and general partners? Is exactly 1 million. The catch-up clause is in action, so everything is captured by the general partner, and 0 is paid to the limited partners. The catch-up is in action. Let's re-see the story. In year number 2, the cumulative capital gain has lifted to 10 million. 109 plus 1 is 110, minus 100 million is 10 million gain. The general partner calculates the carried interest, and the carried interest is 2 million. 1 million has already been paid in the previous period, so I have the right to receive another 1 million. In year number 2, the divestitures have generated exactly 1 million, so the whole million is paid to the general partner, and limited partners get 0. Let's complete the story. In year number 3, the investment has generated a divestiture of 10 million. And in year number 3, we have completed the life. So the sum of the gains is 9 million in the first year, 1 million in the second, 10 million, 20 million. The general partner goes to the limited partners and say, I am entitled to receive a carried interest of 2% of 4 million. In the previous 2 years, I have already been paid 2 million, 1 million in year 1 plus 1 million in year 2. So I have still something to be cashed in of 2 million. And so, from this point of view, since the cash generated by the divestitures in year number 3 is 10 million, catch up basically means that 2 million are captured by the general partners, and what is left, 10 million minus 2, 8 million, is paid to the limited partners. So that if you draw the final balance, the limited partners will receive 108 million in year 1, 0 millions in year 2, and 8 millions in year number 3, 116. And the general partner has received 1 million in year number 1, plus 1 million in year number 2, plus 2 million in year number 3. Total amount, 4 million. Before leaving the floor to question, guys, look carefully at these two numbers, 116 and 14, and compare these numbers with the numbers that we have seen in our Excel file. If you look back at the first example was telling you that 116 and 4 million were paid to the general partners and limited partners with a simple carried interest. And also in this case, you have the same numbers, because also in this case, you pay 116 and 14. So from the point of view of total quantities, the amount is the same. However, the respective annual cash flows, and this is important for Cesare's question, because time value of money can be different in accordance to the different distribution pattern of this cash flow is pretty different. You see that the same two numbers are paid in different ways. Investors receive 1.8 and 8, and limited partners receive, and general partners, so the manager, receives essentially 1, 1, and 2. While instead, in the previous example, we basically paid 18, 02, and 2, and 172, 08, and 8. So the amount doesn't change. The distribution changes, depending on the existence or not of the catch-up clause. Tell me, guys, if everything is clear, or if there is any particular question. I believe it's pretty intuitive, but tell me if something is not clear. Okay, very good. Now, just as a sort of add-on to what we have seen, let me now remove a little bit an assumption, a strong assumption that we made at the beginning of our simulations. And the assumption was no management fees exist. In reality, this is a strong assumption. Rivka, good morning, Rivka. It is not clear to me why we consider the cumulative gains instead of the gains of the year while calculating the GP carried interest. For a simple reason, Rivka, because you must apply the rules as the rules are. And the rules are that if there is a catch-up, I am, as a general partner, entitled to get what the fund owes to me before the limited partners are paid. And in order to calculate exactly what I am entitled to receive before you, investor, are paid, I must always refer to what I have matured, accrued, until a given point. And this is the cumulative capital gain, not the annual one. If you redo the calculations, the only way you can pay to the general partner what is entitled to receive is exactly calculated on the overall gain. Of course, considering the payments that already been received in the previous year. Okay? Very good. Now, let's remove the assumption. In reality, nothing changes very much when including the management fees. The only thing that changes when you include the management fees is that you have to consider that with management fees, and you see now that management fees are in place, and I assume a standard management fee of 2%, the invested capital and the committed capital are different. And if we assume that our fund has a total life of 4 years, you can imagine that with 4 years times 2% times 100 million, lifetime fees will be 8 million. So out of a capital committed of 100, you will be able to invest only 92. Okay? And so the cash flow pattern is slightly different compared to the previous one, because look carefully. In the first row, I have put the invested capital and paid fees. And as you can imagine, in the first year, I contribute all the committed capital, which is now split into components: the committed capital and the lifetime fees. So you can imagine that the fees will be paid annually in year number 1, 2, 3, and 4. And in year number 0, together with the first payment of the management fees, I will contribute essentially the invested capital. So the amount that can be invested in year number 0 is not, like in the previous example, the full 100, but only 92, because you know since the very beginning as an investor that in year number 1, 2, and 3, you will have to pay an additional amount of 2 million fees, 2 million fees, and 2 million fees. So that by the end, in cumulative, you will have to bring to the fund the committed capital of 100 million. For the rest, the story is exactly the same. 109, 1 million, 10 million, for a total of 120. What I wanted to show you guys, and this goes back to Cesare's point. So Cesare, you are still on the right track. If you want to calculate the time value of money for the investors, you must take into account all the components of cost. So assuming, for example, to return to the case of a simple carried interest, you already know this part because we have already commented it extensively. For example, in the first year with a liquidation value of 109, you pay back 100 million, and with a simple carry date, the 9 million capital gain is 80% paid to investors and 20% paid to the general partners. And the same will true in year number 2 and in year number 3. But when you have to consider the final result of the cash flow received by the general partners and by the limited partners, these values are different compared to the previous simulation because, take for example the case of the general partner. The general partner in year number 0 receives the first annual management fee of 2 million. In year number 1, not only does the general partner receive the carried interest, but also the management fees, so 3.8. And in year number 2, not only does it receive 0.2 of carried interest, but also 2 million of management fees, so 2.2. And in the last year, not only I receive 4 million carried interest, but also 2 million management fees. So the cash flows are, of course, more abundant for the general partner. The limited partners, instead, basically receive the same amounts that we have seen in the previous simulation, minus every year a 2 million management fee. So if you compare our first simulation with this second one, you can notice that the cash flows are different. Typically are smaller at the beginning because the invested capital is smaller, and smaller throughout the life because they are weighted by the amount of the annual management fees that are due to the general partner. Okay? So Cesare, these are indeed the cash flows that will be subject to the calculation of time value of money, because this is the basis of the calculation of the returns for the investors. So Cesare, going back to your question, is it clear why we are not applying the time value? Because we still are calculating the cash flows that are subject to the discounting. Okay? Clarified, Cesare? Very good, excellent. Is it clear how the management fees influence the distribution in between the general partners and limited partners? Remember that with management fees, there is a bifurcation between the committed capital and the invested capital, because you know, investors, since the very beginning, that basically 8 million will not be invested. 8 million will be paid annually to compensate the operational expenditures of your general partner. Okay? Crystal clear for everybody? Very good. If it is clear, I have one final point for you that has to do with essentially an important aspect, which is very frequently included, going back to one question that was asked by Lucas. Lucas, not only the typical way to apply the carried interest is carried interest with hurdle rate and catch up, but also with a clawback clause. What is the clawback clause? Clawback clause means that, in a nutshell, and I have prepared this simplified example for you. If, in a nutshell, you, during the life of the vehicle, pay a carried interest, and at the end of the life of the vehicle, you haven't repaid at least the committed capital, you have, as a general partner, to give back this carried interest to the investors. One can say, Professor, but excuse me, you told us that the carried interest can be paid only if the committed capital has been repaid. In reality, Lucas raised the question, and Matteo, no, is carried interest paid? Okay, Lucas was raising the question, and I said it depends on how the carried interest is applied. If the carried interest is applied on a deal basis, what could happen is the following. So it is not based on a cumulative value, but on a deal-by-deal basis. Follow me. Suppose that you have a 100 million fund with a carried interest of 20%, calculated on the committed capital. But we have a carried interest paid on a deal basis. So every time you liquidate an investment, I am entitled to pay the carried interest. So assume that the story is the following. You have started in time 0. In year number 5, there is the end of the investment period. And suppose that year 10 is the end of the vehicle. End of fund. Suppose that you are in year number 3. Assume that no management fees are there. So the contributed capital, so the amount of committed capital that has been provided, is 50 million. So not the full amount. But you have the chance in year number 3 to make an investment exit. So you exit an investment at 60 million. Now, if the carried interest is on a deal basis, the general partner makes a simple calculation. I exit at 60, you have given me 50 million, so I have a gain of 10 million, on which I calculate 20%, so I get a carry of 2 million, and investors get back 58 million. Okay, are you following me? Pretty easy. Now, still, you are in the investment phase. So you still have 2 years to ask the final contributions to the investors. So let's assume that you ask an additional contribution to satisfy the total committed capital of 100 million, contribution 50 million. So all the committed capital has been provided to the fund at the end of year 5. Okay? Suppose that you arrive and you don't do any other investments. You arrive at year number 10 and the liquidation value is 0. So this is the classic case, if you think, of a fund that has started incredibly well because he has been able in 3 years to generate a capital gain of 10, but then did very badly in the following years because I have called another 50 million before year number 5, and then these additional investments have been a disaster, so that the liquidation value is 0. You can imagine that if this happens, the unpleasant story for an investor is that I have provided a committed capital of 100. I have been repaid 58 million, and a carried interest of 2 million has been paid. Because this is the paradox. If you do the calculation of the carried interest only on a deal basis, and this can happen, okay? So, in order to avoid such unpleasant situations, the clawback clause says that if at the end of the life we do a cumulative calculation and the committed capital has not been repaid in full, at least as a minor compensation for the investor, this carried interest is returned to investors. It's a meager comfort, of course, because this fund has been a disaster. But however, you can avoid the paradoxical situation to reward the general partner for a bad job he did. I don't know if the concept of clawback has been clear. The basic story is you can't pay an incentive if this incentive is not deserved. And this is a trick that can happen when the carried interest is paid on a deal basis and not on a portfolio basis, like in the examples that I made. In the meanwhile, Rivka is asking me a question. We don't consider anymore the hypothesis that the 100 are fully committed in year 0 in this example. Absolutely, Rivka. I have removed this, and this is the reality, because it is very much unlikely that all the committed capital is contributed just in 1 year. It takes time, 5 years to make investment during the investment period. And this is typically what in general happens. Okay, Rivka? Crystal clear for you? Clarify your point? Yes, I have removed the assumption to have the contribution only in 1 year. Okay? Very good. Now, going back to our agenda for the day, we are going to move in the last 10 minutes or so to the final analysis, the performance of investment vehicles. In reality, to assess the performance of a vehicle, we have different alternative measures. In general, the most obvious is represented by the internal rate of return that can be calculated, going back to Cesare's point, using the cash flows that we have estimated in our simulation. However, pay attention, because there is a big point. IRR, as you know, Eugenio, the management fees are never touched, right? Eugenio, of course, I have removed the hypothesis in the clawback example of management fees. But on top of that, you must always remember that every year you have to also pay management fees. So this negative effect of my example could be exacerbated by the existence also of the management fees. Management fees are paid in any case. Okay, Eugenia? IRR, I was saying, it is not exactly the best measure to get the performance of private equity investments, because, as you know, the IRR makes the assumption of reinvestments of cash flows, while instead, in a vehicle, you don't reinvest anything. And so IRR is a measure that is frequently used to calculate the performance of a vehicle of private equity, but is probably not the good one. Second element is the IRR can be misleading during the life of the vehicle. Because, as you know from corporate finance, the IRR should be calculated only with cash flows that are distributed to the investors. But during the life, you face always a situation where a portion of the proceeds have been distributed, but some others are still not distributed, because this is the portion of the portfolio that must be still divested. And so IRR is a good one, but not exactly the perfect one. We will see that an alternative is represented by the multiples. And in order to understand what these multiples are and how they work, I have prepared an example for you that closes our session. The example is included in your set of slides, in one of the final pages of your set of slides. More precisely, the example is the following one. Suppose to consider a fund which has a committed capital of 100 million euros, management fee of 2%, a duration of 10 years. So, as you can imagine, 10 years times 2 is 20 million, so the invested capital is 80 million euros. The carried interest is paid, as you know, only after the repayment of the committed capital has been made. In this chart, I have presented you the life of this vehicle in the first 8 years of life, compared to the total duration of 10 years. So we have 2 years left to go. And my assumption is the following. This 80 million invested capital have been invested in the investment period of 5 years. This is the investment period. And I have assumed that I have made 5 investments of 16 million per annum. Total amount, 16 times 5 is exactly 80 million. Second element that you have to consider, for all the years, this is Eugenio's point, I have to pay annual management fees, 2 million. And these are the values that you already know. The third hypothesis that I make is that in terms of divestitures, I start divesting my portfolio, starting from year number 4, for an amount of 20 million per annum. So these are the divestitures. So I sell companies included in the portfolio, 20 million per annum. An additional information, this is an exogenous information, so it is not a calculation. These are my estimations. The general partner estimates the value of the portfolio at the end of each year. For example, in year number 1, I have bought 1 company, and so at the end, the portfolio has a value of 16, exactly the value of the acquired stake. In year number 2, I have made another investment of 16, but the portfolio is worth 40. This probably means that the first company has increased the value, and the second company has been added to the portfolio. So you see the progression of the value of the portfolio: 16 in the first year, 40 million, 80 million, 120, 150, 160, 170, 180. Now, with all these values, we can now understand the position of, and so Cesare, now the time value of money comes out. The cash flow to limited partners. A limited partner, for example, in year number 1, 2, and 3, has contributed 16 million to make investments and has paid 2 million management fees. So in the first 3 years, the limited partner has spent 18 million per year. In year number 4, since distribution starts, the general partner has contributed 16 million, has paid management fees for 2 million, but he has received distributions for 20 million. So 16 plus 2 is 18, minus 20 is 2 million positive. And the same holds true for year number 5. In year number 6, no additional investments are made, and so you get essentially the value of the distribution minus the annual management fee. So Cesare, now it's time to use the time value of money. And if you take these values here, you can easily calculate the internal rate of return. And as you can imagine, this internal rate of return will be very small, because also without making any calculations, you see that the cash flows are almost matched. So one measure of performance is that in year number 8, you have an IRR of 1%. The alternative, since the IRR is plugged by the reinvestment hypothesis, is the use of cash multiples. And the multiple can be calculated in the following way. Numerator is essentially the positive side for the investors. The denominator indicates the negative side. The positive. For an investor, the positive elements are the distributions that have been, the distributions that have been obtained until that point, and the value of the portfolio that has still to be liquidated in that vehicle. So in our example, the multiple is, until year number 8, the cumulative distributions have been 20 plus 20 plus 20 plus 20 plus 20 is essentially an amount of basically 100 million. But you see that the portfolio value after the distributions is not zero. So you still have some firms to be liquidated, which is 160. So from the point of view of the investor is sitting on a potential value of 260. Okay. Instead, the denominator is the negative side. And what is the negative side for an investor? Well, I have invested capital, first of all, and I have paid management fees. And from year number 1 to year number 8, I have invested all the capital. So I have invested 16 plus 16 plus 16, 16 and 16, 80 million. And I have paid 8 years of management fees. So I have paid 16. Please notice that at the end of the life of the vehicle, the denominator will become the committed capital, because all the management fees will be paid. So all in all, this multiple is telling you that out of a contribution plus management fees of 96, you are sitting on a potential value of 260. And at the end of the day, you have an alternative measure that say that for every euro of contributed capital plus fees, you are able to generate you are able to generate a cash multiple of 271. So 2.71 times the cash that has been contributed. Is everything clear, guys? Any question how to calculate the cash multiple? Cash multiple is cash available either because it has been distributed or it is because it is still to be liquidated, divided by the contributed capital, the invested plus all the fees. Okay? Sufficiently clear? You can split this number, 271, and I'm going to conclude, into two components, because as you can imagine, one component of the numerator is represented by real cash, distributions. The other one is only a potential value. And so you can split this cash multiple in the released component, the released cash multiple, when you take as numerator only the cash distributed. And so the released cash multiple is only 1.04 times. and the unreleased value, that is the ratio between the value of the portfolio still inside the vehicle and the contributed capital, 1.67. So to say that the multiple seems attractive, 2.71 times the cash contributed, but be aware of the fact that most of this 2.71 is, let me say, represented by the still unreleased value of the portfolio, being the distributed part only a minor fraction of the total. Okay? Guys, any question before closing our session? Is everything clear to everybody? Okay, so I think we can close this session. It has been a quite intense session, and I truly hope you have enjoyed it. I give you appointment for another session when we will talk about the private equity method for assessing the value of the company next Friday. It will be the usual bad timing, and I apologize for that, but I truly hope you will find also that session pleasant and interesting. For the time being, thanks very much for your attention, and I'm looking forward to meeting with you again in a couple of days on Friday. Take care, bye-bye, and see you next time.